The final two things we want to look at in the business case are the risks of not doing the project and the risk of doing the project. Just to review where we are, we're on the overview and summary worksheet, and we're in the business case summary table, and we've already gone through the do the right thing calculations, and we've got summaries that summaries of the highlights of each of those explorations of that business case element. And now we're down to the bottom two, which are mitigate risks of not doing the project and the risks of doing the project, both of which are on the same worksheet, the risks worksheet. So to get to that, we just click on risks and it takes us to that worksheet. You'll notice that there are no yellow boxes or fields on this worksheet because all the calculations are going to be using previously entered information about revenue, about expenses, etc. So on this worksheet, we have both the risks of not doing the project and as well the risks of doing the project. Starts off with the ones of not doing the project. And what you can see at the top here is the normal way that risks are calculated for anything. So it looks at the size of the potential impact of not doing the project on this particular line item and the probability of that happening within the time frame of the project, which for our purposes we might think is 5 years for the retrofit of the headquarters building project that we are considering in this example. And once you put in those 2%, then the calculation is automatically done for the amount at risk. So that calculation, just to reassure you how it works, is going to take the value in this cell, C6, the value in this cell, D6, and multiply it by what is on the revenue sheet in cell C5. So that's a way in which you can interpret the formulas that are built into this. You don't have to worry about those, they're going to be done for you. But I just want to reassure you that if you want to change any of those formulas, the way to do that is up here in the formula bar. So we're going to start off by taking a look at the revenue side of the equation and look at whether or not if the project of retrofitting the headquarters building was not undertaken, would this negatively impact the company reputation with its customers and have an impact on revenue? And similarly for the other 4 revenue streams that we've looked at before. So you're going to put in the percent impact that might be likely. There's lots of guidance. There's a ton of information in the comments associated with all of these cells. So you can use that guidance and hopefully guidance from people in your company that are associated with those particular line items. And you can also come up with the percent probability of that happening within the time frame of the project. And by the time you're finished, this sheet might look something like this. So as you might expect, the line items in the revenue area that might be impacted negatively if the project were not undertaken are the same two that were impacted positively when the project is undertaken. So percent impact, percent probability, using 50% here is just sort of a mid-range. You can certainly talk about those probabilities with people in the organization associated with the line items, like the marketing folks, and that calculation is done for you based on those 2% and the original value of the revenue. As usual, there's just a ton of guidance around all of these that's baked into the comments. So if you want to look at it, right-click, edit comment. That gives you a chance to see the whole comment, scroll through it, take advantage of whatever guidance there is relevant to your particular situation. When you're finished with it, click on it again and scroll back. So what you do is you go through the revenue line items that way, the energy, carbon, etc. operating expense line items that way. Again, the items that might be impacted if the project were not undertaken are the same ones that are impacted when the project is undertaken, using 50% again. So what you see is some lines are left blank because they're just not relevant to the project. Others are filled in. We do the same kind of thing for the asset value and the market value risks. Again, looking at the same line items that we looked before on the positive side and how these might be negatively impacted if the project were not undertaken. Lots of explanation in the comments. And down below, we have a chance to summarize all of this in a highlight summary of the risks if we were not to undertake this project. So when you fill that in, it might look something like this. This summary of the highlights of what happens if the project or what you might miss in positive cash flow or missed asset value increase gets moved into the summary chart on the overview and summary sheet. But let's continue on and finish the other part of the risks analysis, and that's looking at the risks involved in doing the project. So the ones above were the ones that could happen if you didn't do the project. The risk of doing the project, basically this is looking at contingency risks. So what happens if things go wrong during the project? Cost overruns, delays, problems that it's hard to foresee, but you want to make sure that you've got contingency funds set aside just in case. Many of these may have been thought of before as you were doing the other parts of the business case, filling in those worksheets. So they may be zero. In the case of contingency funds, you might allow for that, maybe a 50% probability that you're going to need it. Then that ends up with half of the 900,000. Loss of asset values, when you're doing a retrofit, things could go badly, badly wrong, and you may actually decrease the value of the building. On the other hand, you're using companies that know what they're doing to do the retrofit, so the chance of that's pretty low. So it's only that. The overall amount at risk of doing the project is only about $610,000. So relative to the other things that we've been looking at, that's a relatively low amount. And the summary of that particular risk can be something like this. So that's summary, and the summary of the risks of not doing the project are both copied automatically by the worksheet into the overview and summary, and they show up as the final two parts of that list of highlights that we've been working on as we've gone through the workbook. And now we're done. There's only one other thing to look at, and that's the project appraisal tool, and we'll do that next.